A deep and diversified investor base ensures demand for government securities, strengthening the resilience of the market in times of stress. Of course, the absolute size of the domestic financial sector defines the domestic absorption capacity for government bonds, and the structure of the financial sector can have a significant impact on market liquidity. But more than that, the investor base should be diverse, that is, comprising investors with different investment horizons and risk-return preferences. This allows the government to spread risk in its debt portfolio and helps to extend the yield curve. We should thus analyze the types of participants in the market, including commercial banks, non-bank investors, such as domestic institutional investors, and foreign investors. Commercial banks usually play a major role in developing countries, typically as dominant investors for government bonds and as intermediaries for government bond trading. Size and structure of the banking sector are important. A highly concentrated banking sector, for example, can undermine banks' incentives to trade, as counterparts are limited. Non-bank investors are also critical as they bring different risk-return preferences and investment horizons. For instance, pension funds and insurance companies typically prefer longer-dated assets to match their longer-dated liabilities, largely determining the ability of the government to issue longer-dated securities, and thereby facilitating the extension of the yield curve. On the other hand, money market mutual funds generally prefer shorter-dated securities, but they facilitate more efficient asset and liability management operations for the government. Still on domestic institutional investors, public pension reforms can increase national savings, though such reforms should be formulated taking broader considerations into account. On its turn, collective investment schemes are useful to encourage retail investor participation while avoiding the extensive use of dedicated products, which can create market fragmentation. A supportive policy environment for the development of domestic institutional investors is then critical. Finally, foreign investors are playing an increasingly relevant role for domestic debt markets. The participation of non-resident investors can enhance the investor base, but should be subject to careful monitoring and robust safeguards. Non-resident investors add different investment perspectives to the domestic market, often increasing secondary market liquidity. They, however, require the market to meet certain preconditions before investing in the country. Furthermore, they are more sensitive to global market conditions and could amplify market volatility, so authorities must weigh the trade-offs. In short, a developed investor base would have a deep and diverse range of bank and non-bank participants, both domestic and foreign. It's also important to look at investor relationship management of the issuer. An active investor relationship management usually strengthens the investor base of the country. An understanding of the risk-return profile and the constraints of the investors provides a sound basis for matching issuances to potential demand, and it helps reduce the cost of funding in normal times. It also helps the government maintain market access in times of stress. Ideally, there should be a mutually beneficial two-way flow of communication between the authorities and market participants.